Hi, everybody. Welcome to Bonding Over Bonds. I'm Allie Krautheim, and I'm joined today by Jim Jackson. Thanks for being here today, Jim.
It's a pleasure to be here, Allie.
We've made it halfway through the year. 2024 has brought a lot of interesting moves in the fixed income market. What caught your attention this past month?
You know, Allie, I think that the markets have been quite reactive to new economic data. This month, we saw CPI hit 3%. And this month's print was lower than expected, really the first time we've seen that in a couple of months. Also, we saw GDP growth surprise to the upside. So really, the market and a lot of investors that are eager for a rate cut just might get their wish over the next few months.
Great point. With the Federal Reserve meeting in July, we gained some more insight on how the FOMC is absorbing this new information and whether this trend of disinflation is sufficient to place them in alignment with market pricing. The market is currently pricing in a near certain rate cut at the September meeting.
You know, I think one thing that investors should start thinking about if they have a lot of holdings in cash that they should consider is what historically has happened to money market rates once the Fed starts cutting.
Could you dive a little bit deeper into that point?
Sure thing. So typically what we have now is we have an inverted yield curve. So yields on the front end are higher than yields in the intermediate and longer end of the curve. Once the Fed starts cutting, what you would see is that yields on the front end of the curve start to move down. So if you're in a money market product or on the very short end of the curve, the rates you would be earning as the Fed cuts would go down.
Makes sense. Money market yields typically follow the federal funds rate pretty closely, so it could be a good time to shift out of cash.
Yeah, so historically what you would see is that as we approach the first Fed cut, the market starts to price that in further out the curve. So the market will longer term rates will tend to move before that first rate cut. So we think it does make some sense for investors that have been on the short end to start to extend further out the curve.
Thanks for the insight, Jim. And thanks everyone for watching and joining us as we bond over bonds.